Hello, this is Mijin Wu from the United States Stock Theory University. Let's start today's United States Stock Theory news for June 26th. Welcome to Mijin Wu, where we continue to uphold the fundamentals of United States stock investing as always. While running the Mijin Wu YouTube channel, I don't think I've ever promoted my paid membership, which I personally manage, as actively as I have recently. Because of that, I think some side effects are happening. Let me read this post to you for a moment. This is a post left by someone using the identification Mariu. Thank you. There's a fear of missing out phenomenon happening with the membership. I'm one of those who wants to join quickly, and now they're shedding tears. And here, someone using the identification Dean 4865 also seems to feel like they have to do something. From what I read, there are some people who feel pressured, like they absolutely have to join the membership. I'd like to talk about this for a moment. I already gave an answer. There are many people who either have a small investment fund or are investing in ETFs rather than individual United States stocks. For those people, there's really no need to join. And for those who haven't taken investing seriously yet, I think it would be better to consider this later when you start investing more actively. I mentioned this before, but right now I spend over 3 million won a month just on membership fees. For example, there's a website called FS Insight run by Topney, and as you can see, the annual membership subscription fee here is over $2,000, which is about 2.7 million won. And if you look here, there's also a platform called IO Fund that provides tech-focused investment information, and the price here isn't cheap either. Let me show you. Right now, I'm maintaining this membership by paying $849 a year. On July 11th, I'll soon have to pay the annual subscription fee again. Why do I spend such a large amount of money to join this membership? My investment funds exceed 1 billion won. So for example, if I'm investing about 1 billion won and I can increase my return by about 10%, that means I can make an additional 100 million won. Therefore, in my case, even if I increase my return by just 10%, I can make an additional 100 million won. So investing $1,000 or $2,000 like this is not a big burden for me. That's what I can say. But if any of you only have 1 million won to invest, even if you make an additional 10% return, that's just 100,000 won. In that case, joining a membership that costs over 200,000 won doesn't make sense. So you need to make a personal decision, considering how seriously you are investing right now, how much you are investing, and how much detailed information you need about individual stocks. If you just join the membership because others are doing it and think, I should join too, in the end, there are many people who don't make use of the vast amount of information provided. So don't just sign up for the membership. Go to the all-in-one membership information page first. I want to tell you to make a personal decision like, oh, this really provides the information I need, or I don't need this level of detailed information yet. All right, then let's get started with today's Big Two news prepared for June 26th. In today's broadcast, thank you for asking a question that's even more important than summarizing the current situation in the United States market. I'd like to give you an answer to this first. This is from someone using the identification J. They commented, I'm worried because I heard a law to raise taxes by 50% for foreign investors has passed the House. And below that, someone asked, is this true? They also added a worried comment saying, I hesitated to invest in United States stocks. This kind of tax really makes me hesitate. So in today's broadcast, I'm going to talk about whether these rumors are true, and if they are, what kind of strategies we investors should use. First of all, as of now, we need to organize the taxes that Koreans pay when investing in United States stocks. It comes down to about two types of taxes. The first is dividend income tax, which is paid on dividends. As you can see here, there is taxation in the United States. So, for income from dividends, the United States withholds 15% at the source. And you don't pay it in Korea. Of course, if your annual income exceeds 20 million won, you will have to pay comprehensive income tax. And the second is realizing the difference. If there's a difference between the price I bought at and the price I sell at, I have to pay income tax on that, right? As you can see here, up to 2.5 million won per year is deductible, and after that, you have to pay a 22% capital gains tax. This is the tax that our investors currently have to bear. That's how you should see it. So, did the United States House of Representatives really pass a bill to increase taxes on foreign investors? Let me answer that for you. On May 22, 2025, as we all know, the United States House of Representatives passed a large-scale tax reform bill from President Trump called the One Big Beautiful Bill Act. And this bill includes a provision called Section 899, which covers not only individual investors from countries that impose unfair foreign taxes on the United States, but also corporations and even sovereign wealth funds. Now, you can understand it as follows. For these people, an additional tax of 5% per year, up to a maximum of 20 percentage points, will be imposed on dividends, interest, and business income generated within the United States on top of the existing tax rates. And yes, in the House of Representatives, a bill to increase taxes on foreign investors has actually passed. However, this bill still needs to pass the Senate, and the final legislative procedures, such as the president's signature, are still pending. And one more thing, recently, in the Senate Finance Committee, there was a proposed amendment discussed which lowered the additional tax rate cap from 20% to 15 percentage points. It also included a provision to exclude portfolio interest from taxation, so you can see that some adjustments are needed. Now, let's look at how this actually affects Korean investors. For those who are in the United States, this probably doesn't matter. Let me explain how this affects those who invest from abroad and Korean investors who are spread all over the world. In conclusion, Korean investors may also be affected because if Korea is designated as an unfair tax country by the United States government, the withholding tax rate on dividend income from United States stock investments could increase from the current 15% to as much as 30%, because the current rate is 15%, and the Senate's amendment is also 15%. So there's a possibility it could go up to 30%. That's why people are feeling a bit anxious. So, for now, this situation doesn't immediately apply to Korean investors. Also, we still have to see whether it passes the Senate and whether Korea will be included as a target for application. Additional taxes will only be imposed if a country is designated as an unfair tax nation, so that's something we need to confirm. And even if the bill is finally passed, it will be applied in stages. It goes up by 5% every year, so it's not like it suddenly jumps to 30%. It's 5% each year. Since it's highly likely that additional changes will occur, we have enough time to adjust our investment strategy. You can see it that way. And the most important thing is whether this applies to stock capital gains. In other words, capital gains. I think that's the key point. To give you the conclusion first, Section 899 of this tax increase is very unlikely to apply to the capital gains of ordinary United States stock investors, because the key point of this tax increase is to raise the withholding tax rate on dividends, interest, and business income generated within the United States. So capital gains tax is not a withholding tax. It's a tax we pay in Korea, so it's not related. You can think of it that way. As stated here, capital gains, that is, profits earned by foreigners from buying and selling United States listed stocks, are not subject to taxation under United States tax law. This is the key point, and I want to emphasize it. According to the United States Internal Revenue Service and the Korea-United States Tax Treaty, foreigners who do not have a tax home in the United States, like us, do not have to pay taxes in the United States on capital gains from trading United States stocks. Let me confirm that for you once again. Now, there are some exceptions here. What about capital gains from trading United States real estate-related stocks, which we call REITs? Those can be subject to taxation. However, regular listed stocks are not subject to taxation, so you don't have to worry about the stocks we love like Taeku stocks. Now here's the conclusion. What about this United States tax increase, Section 899? It only applies to source income like dividends from United States stocks, and it doesn't apply to regular stock trading, capital gains, or profits from selling stocks. Therefore, if you make a profit from selling United States stocks, there won't be any additional tax imposed by the United States. However, the tax on dividend income can go up to as much as 30%. So, if any of you have a portfolio focused on high dividend United States stocks or REITs, it might be necessary to restructure your portfolio by increasing the proportion of growth stocks. Of course, since there's still plenty of time, you won't be late if you wait to see what happens and how the law is actually enacted before making any moves. All right, Mr. J, thank you very much for leaving such an important question. Just a moment ago, I explained in detail that we don't need to leave the United States stock market because of United States tax issues. I hope this broadcast has helped to ease some of your concerns. All right then, everyone. I'm really curious why, when there's also the Korean stock market, you chose to come all the way to the United States stock market to invest like this. It would be great if you could share your opinions through the comment section. In my case, there's a big reason why I invest in United States stocks instead of Korean stocks. As I explained in detail in the video pinned on the main page of the Mijun YouTube channel, it's because I'm investing in the fourth industrial revolution. This video is one I uploaded in 2020, and since then, my investment logic has always been the same. Now, the fourth industrial revolution is gradually accelerating. It's been over 10 years since the term fourth industrial revolution first appeared. But the important thing is, the fourth industrial revolution hadn't even really started yet. Now, starting around 2022 and 2023, the fourth industrial revolution is finally beginning, led by artificial intelligence. And at the center of it are American companies. Therefore, in order to see such valuable investment opportunities, unfortunately, my investment logic is that you have to leave Korea and come to the United States to invest in American companies. And in today's broadcast, in addition to that, I'll show you one numerical analysis. I'll also explain another rational reason why we should invest in United States stocks rather than Korean stocks. First, let me read you an article. It is reported that S&P 500 companies reached a record high in share buybacks, totaling $293.5 billion in the first quarter of 2025. And despite high stock prices, this figure surpasses the previous record of $281 billion set in the first quarter of 2022. Compared to the fourth quarter of 2024, the share buyback volume in the first quarter of 2025 increased by 20.6%, and compared to the first quarter of 2024, it also rose by 23.9%. So you can see that the top 500 companies in the United States are continuing to buy back their own shares on a massive scale. Now let's take a look at the top 5 companies for share buybacks in the first quarter of 2025. As you all know, the number one is Apple. Apple is famous for its massive share buybacks, to the point where you could say that most of its stock price increases come from buying back its own shares. They bought back as much as $26.2 billion, which is the fourth highest amount in S&P 500 history. And also, compared to the $26.5 billion in the fourth quarter of 2024, it actually decreased slightly. So, compared to the previous quarter, it means it dropped a little. And the second company that stands out is Meta. In the case of Meta, they bought back $17.6 billion worth of their own shares. If that's the case, it's not much lower compared to Apple. And one more thing, compared to the fourth quarter of 2024, that's an increase of about 4 to 5 times. Now, the third one is Nvidia. Nvidia has $15.6 billion, and compared to $9.7 billion in the fourth quarter of 2024, it's showing an incredible increase of about 1.6 times. Now, the fourth one is Alphabet. Alphabet bought back $15.1 billion on worth of its own shares, and compared to $15.6 billion in the fourth quarter of 2024, that's a slight decrease. That's how we can summarize it. If you look at the changes by sector, communication services went up by as much as 56.5%. This was largely due to Meta's role, so you can see it that way. Secondly, finance is up by 41%. In the case of finance, JP Morgan is doing well. Information technology went up by 25.8%. This part was largely due to Nvidia's role. You can see it that way. All right? Like this. Communication, services, finance, and information technology have increased their share buybacks. On the other hand, consumer staples and discretionary consumer goods are actually reducing the scale of their share buybacks. Now, for the second quarter of 2025, S&P 500 companies are proceeding with share buybacks more cautiously. That's the interim assessment. Now, let's look at the outlook for the second half of 2025. Assuming that stock prices remain stable, the increased demand for shares to fulfill employee compensation obligations is expected to provide a basis for additional share buyback activities. What this means is that American companies usually give bonuses in the form of stocks. That means they have to keep issuing new shares, which we call the dilution effect. So, in order to reduce this dilution effect, they have no choice but to buy back their own shares. That influence is quite significant. And it is also expected that discretionary share buybacks by companies with strong cash flows will continue steadily. So, aside from the additional compensation given to executives and employees, there will also be a lot of additional share buybacks. Because there are many American companies with very strong cash flows. Overall, in 2025, the increase in earnings per share, due to share buybacks is expected to fall short of previous highs, but total spending on share buybacks is likely to set a new record. Therefore, it is now being projected that a record high amount of share buybacks will be recorded in 2025. Let me sum it up for you in a few words from Mijun. As I keep repeating, stock prices, it's earnings multiplied by multiple. Here, earnings usually mean earnings per share, and the multiple is price to earnings ratio. So if you multiply earnings by the multiple, you get the stock price. We need to remember this. Therefore, for a company's stock price to rise, either the multiple stays the same while earnings go up, or earnings stay the same while the multiple goes up. Of course, if both go up at the same time, the stock price will soar. And if we look at earnings separately here, we call earnings per share stands for earnings per share. In other words, earnings per share is the company's net profit divided by the number of shares. Therefore, there are two ways to increase earnings per share. The first way is to increase the company's net profit, or the second way is to reduce the number of shares even if the net profit stays the same. And I'm going to show you a few charts. Most of the leading tech companies we love are increasing their net profits and the number of shares is decreasing. So, there are two ways for earnings per share to go up. Either net profit increases or the number of shares decreases. The tech companies we love are doing both at the same time. That's why earnings per share is bound to keep rising at an incredible rate. That's how we can sum it up. So in a way, it's only natural that the stock prices of these companies are going up. It's inevitable for their stock prices to rise. That's how we can sum it up. I'm going to show you a few charts now. I'd like you to focus on the trend of changes in the number of shares over the past 3 years. Now, if you look here, the orange line represents the stock price and the second blue line shows the number of shares. Please pay attention to how the blue line changes. Now, you'll also see a purple line, and this purple line represents net profit. Now, if you look at Meta, in the case of Meta, the purple line keeps trending upward. What that means is that net profit keeps increasing. When net profit goes up like this, as long as the valuation doesn't change, the stock price has no choice but to keep going up. So if you look at the orange line here, Meta's stock price keeps soaring. But there's actually one more driving force. Because if you look at the blue line keeps going down. That means the number of Meta's shares is continuously decreasing. So earnings per share is calculated by dividing net profit by the number of shares. And since the number of shares keeps decreasing while net profit keeps increasing, there's a structural reason why earnings per share has no choice but to soar. That's how you can sum it up. It's not just Meta. This time it's Nvidia. If you look at the purple line for Nvidia, you can see it's also showing a tremendous upward trend. Net profit is rising rapidly, but while net profit is going up like that, the blue line is actually going down. So the number of shares is decreasing. So it's only natural that the orange line, which is the stock price, keeps trending upward like this. Now this time it's Google. In Google's case, the blue line keeps going down, meaning the number of shares keeps decreasing. They're continuously buying back their own shares, and the purple line keeps going up. So, as net profit keeps rising and the number of shares decreases, earnings per share has no choice but to go up. In Google's case, the valuation isn't that high either. Therefore, it's only natural for the stock price to keep trending upward. That's how we can wrap this up. Let me show you an exceptional case. I'll go directly into Sikkim Halpa and show you an exceptional stock. It's Palantir. If you come to the main page of Palantir, you'll see a menu called Charting at the end. Just click here. There's a select matrix here. You can do various numerical analyses that you want to find here. Right now, we need three things. First, we need the number of shares. You can find the number of shares under ownership, so go in there and click on the number of shares. Second, we need net income. Net income can be found under profitability, and here net income is what we're looking for, so click on net income. Lastly, we need the stock price. For the stock price, it would be under valuation, so click on price to complete the chart. That way it's set to 1 year right now, but we should change it to 3 years for the past 3 years. If you look at the 3 lines for Palantir, it's actually quite interesting. Now, first of all, if you look at the purple line, it's skyrocketing at an incredible rate. The reason Palantir's stock price has gone up is because its net profit keeps rising like this. Now, here's the interesting part. The blue line is also going up. The blue line represents the number of shares, and just 3 years ago, the number of shares wasn't that high. But this is increasing rapidly, so they're issuing a lot of additional shares for executive compensation. Unfortunately, in the case of Palantir, it seems that they are not actively buying back their own shares to offset this dilution effect. Of course, recently they've been showing some restraint. If you look at the 1-year chart, the number of shares isn't increasing, so we can expect that there won't be any more dilution effects from now on. Anyway, the important thing is that most American tech companies are buying back a huge amount of their own shares. As a result, as the number of shares decreases, the earnings per share is bound to soar. Therefore, net profit increases and a foundation is established for the earnings per share to keep rising. If the earnings per share goes up, as long as the valuation is maintained, the stock price is bound to rise. Therefore, the reason we need to invest in United States stocks is very rational. I'll wrap it up with that. Earlier, I explained in detail why I left the Korean stock market and am now all in on United States stocks. And it's not just any United States stocks either. We need to focus our investments on tech stocks, and this time I'll explain the clear reasons why we should concentrate on tech stocks. An exchange-traded fund that ranks 5th in the world by assets under management is making its debut. It's the QQQ that we're all familiar with. QQQ started yesterday's session at an all-time high. As soon as the market opened, it broke through its all-time high. The problem is, it dropped a bit and ended the session just below its record high. QQQ, which tracks the Nasdaq 100 index, surged along with the broader market amid signs that the Israel-Iran ceasefire is holding. There's something else that further supports QQQ's upward momentum. It's the fact that this exchange-traded fund has achieved what's called a golden cross. A golden cross is when the short-term moving average, the 51-day moving average, crosses above the long-term moving average, the 201-day moving average. Many technical analysis investors take this as a signal that the upward trend may continue. Therefore, when the 51-day moving average crosses above the 21-day moving average like this, it is considered very positive and the momentum is seen as greatly strengthened. QQQ is composed of 100 stocks. It is made up of the 100 largest market cap stocks on the Nasdaq, and among them, financial stocks are excluded. Although it consists of 100 stocks in reality, a few stocks dominate. That's because 10 stocks account for about 48 to 50% of this fund's price movement. Now, if you look here, the stock with the largest weight in QQQ is Microsoft. The reason is that they rebalance every 3 months. Currently, the company with the largest market cap is Nvidia. It went back up again yesterday, but the reason why Nvidia doesn't have the highest weight is because we have to wait until we rebalance every 3 months. At that time, they'll probably buy more Nvidia stock, right? That's why, for both QQQ and SPY, if the stock price goes up every 3 months, they buy more. That's what it means. All of these funds are using a momentum investment strategy. I've mentioned this before, right? Anyway, right now, a lot of Majun's top picks are included in the top 10. I really like stocks with large market capitalizations. That's why it's understandable that as many as 6 stocks are included. Here's the message I want to share with you. Stock investing is about betting on the future. So there's nothing that's absolutely certain. There's no such thing as 100%. So what we as investors need to do is figure out how to increase our odds to more than 50%. That's the strategy we should take. And if you look at the past 10 years, no matter which period you compare, the S&P 500 has never outperformed the Nasdaq 100. Let me show you here. QQQ is the exchange-traded fund that tracks the Nasdaq 100, and next to it, SPY is. It's the exchange-traded fund that tracks the S&P 500, which is made up of the 500 largest companies by market capitalization in the United States stock market. Now, over the past month, QQQ went up by 6.27% and SPY is up by 4.84% QQQ1. Now, if you look at the 3-month period, it's 9.67% and here it's 5.50%. Okay, then let's extend it to 6 months. The 6-month return is QQQ at plus 2.11% and SPY at plus 0.97%. If you look at it over 1 year, QQQ is up 12.89% and SPY is up 11.43% over the year. It's the same for 3 years, plus 83%, plus 55%. Over 5 years, QQQ is up 119% and SPY is up 97%. It's the same over 10 years, plus 391%, plus 189%. So regardless of the period, SPY has never beaten QQQ even once. So, focusing your investments on United States tech stocks isn't just an investment preference, it's a statistically proven high probability bet. So this is why we build our portfolios mainly around tech stocks. Just as historical statistics support it, I want to emphasize that the chances of success will continue to be higher going forward. Now, let's take a look at the momentum of QQQ. Out of the 26 indicators, 3 are signaling sell, 8 are neutral, and 15 are indicating buy. Now, if you scroll down and look at the price chart of QQQ, technically, it looks very positive. Here, it's forming a double bottom, a W-shaped bottom, and making a V-shaped rebound. And there was a very strong resistance line, which was around $500, and it has broken through that level. Now, if you look at the moving averages, you'll see 2 types of moving averages. When looking at short-term trends, it's good to compare the 20-day and 60-day moving averages. The 20-day moving average is orange, and the green one is the 60-day right now. The 20-day moving average has crossed above the 60-day moving average, creating a golden cross here as well. So these various technical indicators are really excellent, and what's even more important is that we're currently at the highest point here. So the upward momentum is very strong, but you can see that we've reached a very important and decisive moment right now. Now, if you look here, the all-time high is $542. It got blocked here twice, but if this time it breaks through and stays above $542 for a few days, that's historic. With a new all-time high being set, it means we're entering a new upward phase. That's how you should see it. But if it hesitates here and falls again, then that's a triple top, right? It means it's been blocked at the same spot 3 times. If that happens, there's a possibility it could turn into a downtrend, at least in the short term. The 20-day moving average is at $529, and after that, there's the $500 support level, right? You can see that there are still support levels remaining. Now, anyway, what's important is this. We need to check whether it will surpass the all-time high and enter a new territory. In the next article we've prepared, Meta appears. Personally, I'm very pleased to hear that Meta has recruited 3 researchers from OpenAI this time. To explain just the key points, Meta has strengthened its superintelligence team by recruiting 3 researchers who were working at OpenAI's Zurich office. But this kind of news was mentioned by OpenAI's Chief Executive Officer Sam Altman a few days ago. He criticized Meta, saying that they're trying to poach talent right now. But in reality, these rumors have actually come true. That's how you should see it. At that time, Sam Altman claimed that Meta had offered a $100 million bonus to recruit OpenAI employees. I see this news as very positive. Let's hear what this is about. What is this news about Meta recruiting OpenAI talent? Because the opportunities brought by the artificial intelligence revolution are so enormous, I would like to say that this is a very symbolic event showing that global big tech companies are going all in and staking everything on it. Just like in the past with the internet and the mobile era, artificial intelligence is now the most important technology that will determine the dominance of future industries. Companies are feeling a sense of crisis that falling behind in the current artificial intelligence technology race doesn't just mean missing out on a new market, but could lead to being left behind in all future industries. That's how I see it. I would say that this is exactly why Meta is aiming beyond being just a social media company, setting its sights on artificial general intelligence, and superintelligence. Artificial intelligence, especially cutting-edge fields like artificial general intelligence, are driven forward by a small number of brilliant researchers. So what they secure is this. It's not just about increasing the number of employees. It also slows down the technological progress of competitors and accelerates the advancement of their own technology by several years. So from Meta's perspective, they're doing a great job, and you'd want to praise them for that. Now, what about the hundreds of millions of dollars in bonuses mentioned in the article? I think this is key evidence showing just how fierce the competition for talent is. Just like Nvidia's stock price and performance are proving. Recently, astronomical amounts of money have already been invested in building artificial intelligence infrastructure. Microsoft, Google, Amazon, and even Meta, all the big tech companies, are pouring tens of billions of dollars into data centers and purchasing artificial intelligence chips. This means, should we give it a try too? It's not just about the scale of investment. It's that, in the midst of this massive paradigm shift called artificial intelligence, companies are pouring everything they have into ensuring their future survival and securing a lead in the market. That's how we can evaluate it. It's extremely desperate. I think it's right to say that fierce competition is happening right now. Now, if the world's top companies are competing and investing with their survival on the line, then of course we as individuals should be doing the same. In this uncertain era of artificial intelligence, for our own survival and for our families, we need to do the same. I believe it's a very reasonable logic that we should invest in artificial intelligence beneficiary stocks like NVIDIA. Now, rational bets backed by numerical evidence and logic always have a very high probability of success. Now, in this era where artificial intelligence is becoming mainstream, artificial intelligence beneficiary stocks with extreme volatility can actually become the safest investment options. So many people feel that holding stocks with low volatility that move very slowly is usually safe. There's nothing more dangerous than a company that falls behind the times or an individual's future that does the same. So the times are changing incredibly fast. I want to say that finding and investing in companies that are keeping up with these changes is actually the safest investment. What's the last content we prepared for today? The trend of the times that I passionately explained earlier, the one we must invest in and, like artificial intelligence, cannot afford to miss. It's news related to Bitcoin. Rather than news, it's actually a report. You know Cathie Wood's ARK Invest, right? They publish a report related to Bitcoin once a month. As you can see, it's a very detailed report with about 22 pages. But for us individual investors, reading all of this is a bit of a painful task. I don't really want to read the whole thing either. But we do have one way, that's the Medium podcast. So on today's Medium podcast, I've neatly summarized the Bitcoin report from ARK Invest, which is run by Cathie Wood. It would be great if you could take a look at how ARK Invest is diagnosing the future of Bitcoin in a way that's a bit easier and more fun through the podcast. That's it for today's broadcast. I sincerely thank everyone who stayed with us until the end today. Everyone, if today's broadcast was even a little bit helpful to you, please don't forget to leave a valuable comment and give us a like. Let's all keep going until the day we can retire through investing in United States stocks. Have a happy day. Thank you. Hello. Today, in my hand, I have ARK Investments May 2025 Bitcoin Monthly Report. Through this material, let's take some time to look at the recent interesting changes in the Bitcoin market, as well as some hidden signals in the macroeconomy. Now,
then let's take a closer look at the key points. May was, how should I put it, a really important month for Bitcoin in many ways. There's a lot to cover, not just about price movements, but also the relationship with traditional assets, internal network trends, and even the broader economic situation. That's right.
of course, the first thing that catches your eye is the price, right? In May, Bitcoin surged by a whopping 11.1%, reaching an all-time high of $112,000.
Yes, it was really amazing.
Looking at the price at the end of the month, the average purchase price for short-term holders is about $96,000, and it has surpassed that too. The 201-day moving average, which shows the long-term trend, is $94,700, and the on-chain average price is $69,000. It has easily surpassed all these major price support levels. It's truly an impressive momentum here.
Another interesting point is the comparison with the Gold Exchange Traded Fund. In April, there was a net inflow of $9.2 billion into gold ETFs, but in May, it dropped sharply to just $1.5 billion.
So gold slowed down a bit, but the Bitcoin Spot Exchange Traded Fund was completely the opposite. In April, there was a net inflow of $2.5 billion, but in May, it was $5.5 billion, which is more than double. So it surged by 121%.
121%? Wow, that's incredible.
That's right. This is a completely different trend from the first quarter, and you can see that there's a clear change in preferences within the asset market.
But the ARK report says that the current level of unrealized gains for Bitcoin is different from the past, more frenzied markets, right? Yes.
That's right. Statistically speaking, we usually say something is irrationally overheated when it deviates more than 3 standard deviations, or 3 sigma, from the average. But right now, it's only about 1 standard deviation away.
Even though we've hit a new all-time high, the market is calmer than expected. That's what you're saying.
That's right. Prices are high, but there aren't the same extreme overheating signals as in the past. That's the assessment. But there's another conflicting signal we need to pay attention to here.
What is it, Bitcoin?
You know, the core code, Bitcoin Core, the developers' code change proposals for it. This is called a commit, and the number of these commits has dropped to its lowest level since 2013.
The lowest since 2013. How much has it decreased?
Compared to the peak in 2021, it's almost 1/10, only 704 cases, just 1/10.
1/10. I mean, the price is at an all-time high, but key development activity is at its lowest in 10 years. This seems a bit strange. Does ARK see this as a bearish signal?
Yes, that's right. ARK sees this as an indication that Bitcoin is becoming less of an evolving technology or platform and more of a fixed value asset, like digital gold, solidifying its role as a currency asset.
So it means that the focus is shifting more toward asset value rather than technological innovation, right?
In the long term, this does raise some questions about Bitcoin's potential for innovation.
I see. On the other hand, you said the situation is different for mining?
Yes, the mining side is also interesting. The mining difficulty keeps increasing, and with the halving effect, the hash price, that is the profit per mining computation, has actually decreased. But surprisingly, there was an analysis that showed the total profit miners take per block has remained steady since 2020. Oh,
That's right. There have been a lot of talks about how the mining industry is struggling and not sustainable, but are you saying the actual profits are being maintained? That's interesting.
yes, so that's a result that's a bit different from the pessimism about the sustainability of the mining industry. ARK also gave a neutral assessment on this part.
I see. So even in the difficult mining environment, profitability is somewhat protected. Can we see this as a positive sign?
Yes, that's right. Now, shall we take a look at some signals from the real economy? The report points out the United States housing market, saying that there are noticeably more people trying to sell their homes, that is, sellers, than there are buyers.
Oh, that's something I hear a lot around me too. People say it's really hard to buy a house these days, right?
This is analyzed as a result of the Federal Reserve's interest rate hikes since 2022, which have severely reduced people's ability to buy homes.
In the end, this situation is bound to put downward pressure on housing prices.
Yes, that's very likely, very likely. And there are also some concerning indicators in the service sector. There's a survey of corporate purchasing managers called the Institute for Supply Management Services Index, and if you look at it, the price index for what companies pay for things like raw materials hit its highest level in 2 years in May, but on the other hand, the new orders index that companies receive hit its lowest level in 2 years.
Oh my, costs are rising, but demand is decreasing. Isn't this a really bad sign?
That's right. This is a very unusual gap, and of course it will put pressure on corporate profitability. And historically, this kind of phenomenon is often a pattern observed before an economic recession or a sudden policy change.
Oh, really? That's a bit concerning. The automobile market isn't doing well either, yes.
It's the same with the automobile market. Because of the demand to buy before the tariff increase, sales temporarily rose in March and April. But once that ended, in May, sales dropped sharply to 15.6 million units, falling short of expectations.
So as soon as the pre-purchase effect disappeared, sales plummeted, right?
That's right. On top of that, used car prices have dropped by 20% compared to their peak during the pandemic, showing deflationary pressure, in other words, downward pressure on prices. So it's clear why ARK has given a bearish outlook on the housing and automobile markets.
It definitely feels like warning lights are flashing in the traditional economy sector.
Yes, amid these macroeconomic warning signals, there have been other developments within the Bitcoin ecosystem. For example, there's news that the state of Arizona has passed a bill to include Bitcoin as part of the state's strategic reserve. And there's news that the major exchange Coinbase has acquired a derivatives exchange clearinghouse, and there are also talks about the possibility of being included in the S&P 500 index.
Oh, and there has been some progress in discussions about stablecoin regulation bills, and there was also news that Circle, the issuer of United States dollar coin, has filed for an initial public offering. It also seems important that there is a steady trend of cryptocurrencies continuing to move toward institutional adoption.
Yes, that's right. Now, shall we summarize? In May, Bitcoin showed very strong upward momentum with a price surge and exchange-traded fund inflows. But at the same time, there was a somewhat contradictory situation where core development activity shrank to its lowest level in 10 years.
So bullish and bearish signals are coexisting.
That's right. In addition, in traditional sectors of the economy like housing, services, and automobiles, clear warning signals are being detected. Then,
Lastly, as the price of Bitcoin reaches an all-time high and seems to be strengthening its status as digital gold, why is it that the core development activity, which can be considered its technical foundation, has become so quiet? I hope you take some time to reflect on what kind of questions this raises about the long-term value and future of Bitcoin.
that concludes today's analysis. I'll be back next time with more interesting material. Thank you.
No matter what you do, the beginning of a dream is important. Be ambitious and grow little by little every day. Enjoy today's journey. Even if dark times come, I'm not afraid. Retire with United States stocks.